as the Fed gets closer to the end of tightening, and I think they're very close, or certainly the end of this round of tightening, they're going to pause. As that happens, you're going to see a lot of people have to scramble from that side of the boat over to the other side. I think we're going to have a buying stampede, and I think people are going to find out what is meant by thin markets, because with so many people positioned bearishly and all, it's kind of the opposite of someone yelling fire in a crowded theater where everybody rushes for the exit and you have a stampede out. This will be a stampede into the market where they all recognize in a very short period of time, in a fairly concentrated period of time, that they're mispositioned and that they need to move over from being short or being defensive into being more aggressively long. And as they try to get back positioned long, and as you get short covering, you're going to have not a lot of, you're going to have to pay up to get those stocks, because you're all on the one side trying to buy from the very few people that are selling. So I think it can really move a market in a short period of time a long ways. That's what I mean by a melt up. And part of it is we are more than 80 years into a super cycle. So I define a super cycle as the long cycle between two depressions. And I think we're in the final decade of that super cycle. I think it goes on into the balance of this decade, and then we get another huge depression. But we're also in the 41st year of a secular bull market that started in August of 1982. I date it back to then as a secular bull market, because that's when interest rates and inflation began trending down, and that's really what drove the markets to many multiples of what they were back then, because you had back then 15-20% interest rates in the US. As they moved to almost zero back in 2020, the PE multiple moved in the opposite direction. So you started out this bull market back in 1982 with 7 or 8 times earnings, and you're now up around 20 times earnings, or were, and I think we'll probably peak out above that. So this is kind of the last hurrah of a 41-year secular bull market. And then on the other side of that, and I think that happens in the next 3 to 6 months. On the other side of that is what I call a global bust. And a global bust, by my definition, is something bigger than a recession, shorter than a depression. So it's not drawn out like the 1930s were. It'll all happen within kind of the speed of a recession. So most of it within a year, but it'll be the damage of a depression. It'll feel like a depression. There'll be a lot of financial dislocation, a lot of involuntary debt liquidation, bank failures, big bank failures. So we're seeing a little bit of that, obviously, with Silicon Valley Bank, Signature Bank. So, those second and third largest banks, U.S. banks to fail in history. That's kind of what I call the shot across the bow, or the tip of the iceberg. And we'll go through this melt up first, and then I think you'll see the second shoe drop, not to throw out all these metaphors, but the second shoe to drop will be the bust. We'll probably be in recession soon, but then that will gravitate into or morph into a bust at some point. The reason it's confusing is because I think we're going to have perhaps the biggest rally in history just ahead of us, the next 3 or 6 months, and then an 80% bear market and global bust right after that. So and the reason is because everybody kind of positioned for the global bust starting a year ago. And now we're finding out that maybe there's no bust. Again, my view is that we're going to have a global bust. The marketplace is not going to be thinking global bust when they're buying stocks. They're going to say the Fed tightening is over, central bank tightening is ending, and this is the beginning of a loosening cycle, or the beginning, markets rally when the tightening ends. One of the things that I think, if you look back, it's really been about 18 months that we've been talking about tightening, because even before the tightening started a year ago, you go back 6 months before that, and there was plenty of conjecture about the Fed needing to tighten, that, the markets were getting overheated and the economy was getting overheated. So the market's been dealing with the fear of tightening for 18 months and actual tightening for a year. And that's been a huge headwind that was, big reason why the market underperformed last year. And that's coming to an end. So all of a sudden you lose that headwind and the markets are free to run. I don't think people realize how much that Fed, the fear of Fed tightening, and the fear that Fed is tightening too much, and the fear that that's going to lead to a crack up, all of that was what was weighing on the market. If the marketplace, if investors begin to sense, as they are, that the Fed is ending its tightening, or at least pausing its tightening, you'll get that will begin the rally, or take it farther. We really started this in October of last year, but it will, it'll move up to the next level. And as this market starts moving above new levels and resistance levels, it's going to draw in more and more investors. More and more investors are going to be nervous about being on the sidelines or being positioned bearishly, and they're going to come in. As you probably know, markets move on momentum. So you will see FOMO. You will see them. It's fear of what the train's leaving the station. I got to get on board. So I think that's coming. And it is important for me to say I am a forecaster. So I'm strategist. So I'm forecasting. By no means am I endorsing, what people should do. I'm not endorsing the rally. I'm not saying this is sane. I'm saying basically this is what I see coming. Everybody has to make their own decision based on their own risk tolerance and how 100%. Nimble they are, whether they even try to play it, because there is, I think, a lot of negative coming on the other side of this. The reason I even think this is important to know is because the way psychology works, people will be all in at the top if they aren't aware of what's coming. They're going to miss the rally, jump in near the top, and then get slammed as the thing goes the other way. So people should at least understand, I'm calling for S&P to 6,000 or 7,000. 6,000 to 7,000 is my target. From here, that's 50 to 75% move in perhaps less than 6 months. That's unheard of. I mean, that would be historic. If you miss it, what are you going to feel? What kind of pressure are you going to feel when at 6,000 or 6,500, all the strategists on Wall Street are saying there's clear sailing ahead, get in, right? You're going to say, well, I got to get on. I can't miss any more. So if I'd rather you understand when everybody's bearish that maybe there's an opportunity than to get bearish at the wrong time right at the top. I think the melt up is specific to the U.S. If you look at some of the other markets, they're nowhere near the setup that we have here. So like I said, this is the end of a secular bull market. Some of the European markets, are farther down. They'll all have sympathetic rallies. They'll all be dealing with some of the same global fundamentals. But it doesn't mean you're going to get parabolic run-ups in all those other markets. I think the U.S., it will be a parabolic run, meaning the rally's going to get steeper and steeper until it goes almost vertical at the end. And that's why it sounds crazy to say you can cover, from 4,000 to 6,000 or 7,000, 2,000 or 3,000 points in less than 6 months' time. Well, the last 1,000 to 1,500 of those points may happen in a month's time. If you think about individual stock, Tesla is a good example, but any individual stock that went through a real run up, at the end of its cycle, it goes straight up. It goes what we call parabolic. Mm-hmm. And that's what I think we'll see in the market. This bust is not the end of the world. There's going to be a recovery cycle after it in probably second half of 2024 and into the end of the decade. So, but for this rally, this what I call the melt up rally or the blow off rally, for this rally, I think it's going to be broad based. So you will get growth and you will get value. You will get tech. You will get heavy industrial, old industrial. You will get financial, believe it or not. You will get things that are driven by interest rates coming down and things that are driven, typically faster growth, and things that are driven by, an economy that's expected to recover because investors are looking over the trough. If they believe the Fed is ending its tightening, they'll begin to look over the trough to the next cycle. So you're going to get a broad-based rally. And I know lately people have been worried that the rally is of narrow. It's been very narrow with, a few of the large cap tech driving it, but that'll all broaden out, I think, soon. My guess is, we may pull back a little bit more next week, but my guess is you're going to see 4,600 pretty quickly after we finish this pullback. So you might get a 2 or 3% pullback, if that, and then run to 4,600. I think in that run from 4,000 to 4,600 and 4,650, somewhere up there, I think it'll broaden out quite a bit. You'll see cyclicals work, you'll see tech work, you'll see the things that I am more turned off to or don't think they will perform as well are the defensive stocks that have kind of held up through the bear market. So, utilities, energy. I'm not a big bull on energy. I think oil is probably going to, I called it going down to the low 60s. It got down to the mid 60s before OPEC, Saudi Arabia cut production or announced their production cut. So we're right back up into the 80s 80s. I don't think we're going to get much above this. Could get to the mid to high 80s, but I think we could just easily go back to the low 60s in the next couple months. It's a weird cycle because inflation's up near double digit, or was, and yet rates didn't get anywhere near that, right? So you normally expect rates to get up there to shut things down. The rapidity with which the rates were raised, we hiked 500 basis points or close to 500 basis points here in the States. The rapidity with which we saw that rise in 6 months' time, that's the tightening. We've got a very steep inverted yield curve, steeper than ever in history. That's the tightening. People are looking at nominal rates and saying, oh, they have a long ways to go, or they might have to go to 7% or whatever. No, because of, and we had a pandemic, so you have a lot of fragility. And we have more leverage in the system than ever before by a long shot. So we've got 300 trillion in global debt. We've got quadrillions in notional value of derivatives. That's leverage like we've never seen in any other cycle. 2008 and 9 was not even close to this leverage. So all those things are added risk. The Fed is over tightening. I think ECB is over tightening. You guys are beginning to maybe pause. And so I think we're at the end of that tightening, and I think we're going to find that they over tighten. There's leads and lags to this stuff. So right just ahead of us, even though I'm calling for a big rally, just ahead of us is a recession. And then, as I say, that recession will morph into a global bust by the end of the year. So we're not looking at a strong economy. This market is not going to move up because the economy is strong. It may move up because people think we're going to have a soft landing. I don't think we are. Obviously, my global bust is a hard landing. But I think for several months, it may look like a soft landing. As rates come down, that will help housing temporarily bounce. I don't think we'll see new highs in housing, certainly not here, but it could bounce. I think we'll see autos bounce. So it could be through the spring and summer, it looks like the economy is bottoming out and looking better, when in fact it's not. When in fact it just takes time. The markets, economies evolve into what they're going to. To have what may be the biggest rally in history, followed by the biggest bear market in 90 years, because the last one where we were down 80% was basically 1929. To call both of those things happening within a 12 to 15 month period is insane. But it's just the way we're set up. I think it's another sign of us being so late in the super cycle when things get very volatile. If we get a global bust, it means, and it'll be, global bust is an economy probably rivaling the worst we've had in the post-World War II era. So that's, economically, it's going to be a really hard landing. Financially, I think we potentially, because of all that leverage and because of central bank error, I think we potentially could have a financial crisis that's the worst in history. So worse than 2008-9. And so, the central banks are all sitting around and go, well, we need to deal with inflation. We're going to, you might have to suffer some pain in the economy. What they don't realize is because they're going too far and it won't show up for many months, when it shows up, it's going to be so bad, they will be deer in headlights. They'll be, oh my God, you know what March 2020 was like? This will be worse. They will be scared to death going, what in the world? And you'll have major banks, probably Europe is the most vulnerable because of the state of their banks. But, around the world, you'll have major banks going under. The only thing they can do to react quickly is print money. You can't do fiscal policy in a hurry and solve this. I mean, they'll do moratoriums and they'll do things to kind of stem the tide, but they're going to be printing money. Like if we thought March of 2020 or 2020 and 2021 was big money, this will be 5 times that. Let's say they start printing like there's no tomorrow by the end of this year or early next. It won't show up in the economy. It'll maybe stop the free fall at some point within that first 6 months of doing it, but the economy will still be struggling through for a good year anyway, and maybe more. So you're not going to see, and inflation is going to be a lag of at least a year, maybe 18 months or more. So you're not going to be seeing all of that right away. But that money, yes, and that's why they'll go so far. They'll print. It's not like they're going to shovel 20 trillion. I predict the Fed will be putting 20 trillion of new money into the system. So they'll go from 9 or 10 trillion to 30 trillion. I mean, and keep in mind, we weren't even at $1 trillion back in 2008. That's how far we've come. If I'm right, that's what it'll take to stop a free-falling financial system, and proportionally the same thing from, your bank, from ECB, from even the Bank of China, we're going to be looking at money coming out of every place it can come out of, because we've got this highly leveraged financial system that's going to be cratering. That money will, with a lag, and I say probably beginning, sometime second half of the decade, so 2025 and beyond, is going to start that inflation cycle that I think will take inflation in the U.S. up to 25% by the end of the decade, and take interest rates up towards 20. And, and all the other, this is not going to be unique to the U.S. It's going to be around the world. The levels will be different, but it's going to be a hyperinflationary cycle across the globe. It will be, and I was investing in 1982, early 1980s. It will be the early 80s on steroids. So people think they're seeing inflation in this last year. This is nothing. It's going to be sustained for several years. Now think about what that implies for the governments. This 300 trillion debt will probably grow because the monetary stimulus will be accompanied by equal fiscal stimulus or fiscal input. So you're going to look at if the U.S. does 20 trillion in money, they'll probably do 20 trillion in new fiscal spending. So in many different forms, they'll be backstopping things, trying to save the pension system, et cetera, et cetera. Think about how we finance, how we service that debt, the debt that's already too high to service. If we add on another 10 or 20 trillion to that, and we do it at 15% interest rates or on the way to 15, they can't. There's no mathematical equation that solves that, right? I mean, they'll be using their entire budget, the budget they typically have to fund Social Security, Medicare, military, welfare, et cetera. All of that's going to be used up just to service the debt. So what they'll be doing for the first couple of years, because inflation's going to start from negative, because we'll be in deflation in the bus. So it'll start at negative. So it'll take a couple of years for it to get above 5%, right? It'll go negative to maybe 1 or 2% the first year, and then 4 or 5%. And then all of a sudden it goes 5 to 10, 10 to 15, 15 to 20, so in the first couple of years, they'll be obviously dealing with lower interest rates, so they'll be able to fund it for a while. But as the rates move up and as their budget starts getting constrained, they're going to be doing the very most dangerous thing you can do, which is floating more debt to service your debt.